Well, in this session, we're going to talk about money in the stock market. The question is, where's the money coming from and where does it go? And what on earth is going on, given all the variables which have been amplified since President Trump was inaugurated and has had massive impact on financial markets, global markets, trade markets, you name a market, and the odds are the president has had some sort of impact on it, leaving investors wondering, what are we to do? My name is Don Creech.
And I'm Perry Sykes, and welcome to the Investor Resources Podcast.
So one of the traditions of the last 4 or 5 years has been to buy the dips. Retail investors have learned over the last decade or two that whenever the market backs off, the Federal Reserve is going to step in and bail out the problem, and the market will go back up. So in a sign of softness, get out your checkbook and put it in your stock account. That's been the routine until just recently. So one of the things that's been interesting, particularly as we record this and we look at the week leading up to and this week, the week of Memorial Day holiday, the market had a big rally coming off the April low. And what we have seen this time around is that the recovery has actually resulted in retail investors and the financial advisors who generally service retail investor accounts have been selling into the rally rather than buying the dip, which is the exact opposite of what we normally see, because the normal flow of money in the market is that institutions buy low and sell high, and retail investor emotions drive their decisions more often than not, and they buy in late and sell low after things didn't work out the way they wanted. And this time, institutional investors are underweight stocks and are active buyers in this rally, unusually so, while retail is saying, enough. I can't handle this anymore. Give me my money back and let me, put it in something safe where it doesn't fluctuate. I know tomorrow what it will be worth.
And investors at some point have to take a deep breath. They got to step back and, like you said, Don, basic investor behavior says if there's a big move into the market from retail investors, we're close to a market high. Everybody jumps in finally after there's been a big rally. And on this rally, they're just not following in. I think there's a little too much uncertainty, which is why we were talking about where's this money coming from when we get these big up moves. And if it's not the retail investor coming back in, what's going on? And some of it's coming from the bond market. People in bonds just are not working the way traditionally they have. They can't be counted on currently as a safety valve against anything, especially against equities. Are moving more in sync with equities than they have in a long, long time. So some of that is people just giving up on bonds and saying, okay, if I'm going to get the same roller coaster, I might as well buy equities where I have a potential for some gains over time that aren't going to exist in the bond market. But as everything else in this market right now, nothing's going quite per plan, and that's an old saying in investing. This strategy works until it doesn't, and then when it doesn't, it just goes south quickly.
Well, part of the frustration is there are many new variables. Obviously, the tariff issue is a strange one, and we have companies now saying they're going to invest massive amounts of money in the United States and rebuild factories or build brand new ones. That's a positive, but not right away. I mean, what it means
takes a lot of time. Yeah.
What it means right away is the companies have to spend a ton of money, and there's no return on it for another 5 to 10 years.
Right.
And while stock investors have a tendency to look forward, most of them aren't waiting that long to see some return on their capital because it's risky. But you point out that what bond investors are frustrated with is bonds have been at least as volatile as stocks, and historically have been more
Right.
volatile than stocks, but investors have been unaware of bond market volatility because it's not reported regularly like stock prices are.
Correct.
Bond
Every
price
day.
bond prices are much more difficult to actually find out what one is worth, and
Right.
it, and you won't until you decide you want to sell your bond.
That's the way it
That's
works. Yep.
that's where the rubber hits the road, as the saying goes. But what's been interesting is that we have had surges of retail money. So there are people who are still saying they don't believe the market's overpriced. They see opportunity
Right.
as companies announce maybe more conservative, but still an optimistic application of artificial intelligence in their various business uh, activities, whether that's at the warehouse level, the retail inventory control levels, staffing level, or in creativity. But AI has a lot of applications that we don't really fully understand. So any company that comes out and says, things don't look like they're going to be as strong as they were last year because of the change in tariffs and the supply chain has some variability to it. But we do believe that what we're doing with AI is going to create this new opportunity for us.
Right.
Investors respond to that, and we see some money flow into those areas. And then
And
there's
especially in AI, like I said, especially with that, with when AI is the catalyst, the big catalyst right now, of course, in AI is, um, well, it's not going to really do anything any real, radically better than a human being. But the key is there won't be a human being there. So the payroll implications alone are massive, in that while we can be just as good with half the number of employees, and so the productivity numbers of the remaining employees go through the roof because they're still going to get great productivity out of the AI process, whatever it is they're having it do, but you don't have to keep paying it a salary every day. So the productivity numbers are going to be magnificent at the beginning, and then become more and more normalized as AI becomes not the new wave, but the just the normal way of doing business, which appears to be what's going to occur.
Well, the bottom line, where's the profit is the driver. We
Yeah.
want to know if the company's going to earn money. And you mentioned payroll, but payroll brings along with it a whole bunch of associated costs.
Oh, sure.
You have paid time off, you have insurance costs, you have liability insurance costs, you have audit and record keeping. I mean, a lot of things go away because you can reduce your staffing issue.
Sure.
And as long as you're not the consumer who's expecting a high level of personal interaction when you walk into the store, I mean, you may find yourself with some disappointments.
Right.
I
Of course,
was,
there's
I was,
far fewer people walking into stores too. Everybody's shopping online anyway, so it's like that's gonna all evolve, and then we'll have to wait. That's one of the another uncertainties is to wait and see. Where's that going to hit first? Where's it going to hit hardest? Where's the biggest change is going to come? And that's all to be determined.
so part of the way that individuals have to deal with this is really become very disciplined in their decision making process. One, they have to know how much risk tolerance they can actually handle because you must be able to handle drawdown whenever you're invested in the capital markets. Doesn't matter whether it's stocks or bonds, both of them have downside risk associated with them.
Yep.
That means you need an investment process. That means you need some data. You need to take some training or self study in one way or another to develop your process and your rules, and then follow the rules because the rules will keep your
Right.
emotions from making horrendous decisions.
Which you usually will if you're doing it emotionally, and the discipline part of that, like you just mentioned, Don, following the rules is so tough. You can have the best investment strategy for you dialed in completely, and unless you follow the rules, it's not worth the paper it's written on. If it is actually written on paper. but you have to be disciplined enough to do it. You've got to follow that plan. We do it all the time, and we always say the rules are going to make you do things you do not want to do. You're not going to feel like it's the right time, the right place, or the right sector to be in or get out of. And what you have to do is just follow the rules, especially if you've been building them for a while. Have confidence in your plan. And even when it looks like I don't understand this, the rules are more likely going to be on a better side of a trade than you will, worried about what's going on. That worrying about a trade, worrying about a decision, that alters what you're going to do so much. And it's almost never in a good way. So you need to get the rules-based portfolio in force, and then follow the rules. We do that just as best we can all the time. We try to never deviate from that process.
Well, I can think of a recent situation where the rules forced us to, I'm going to use a financial term, load up on
Yeah, there
small
you go.
and mid cap stocks, and we're looking at
Right,
that and saying, man, these have been losers for so long, and yet looking at recent returns, they were at the top of the leaderboard, our leaderboard, the one that we've built out of our menu for our menus.
right.
And we looked at that the next couple of days and we're just shaking our heads and saying, boy, this hurts. But what has happened around Memorial Day is we got a great big rally, and guess what's at the top of the leaderboard? The small and mid cap stocks. I mean, there's still some dominance with large cap tech, but small cap and mid cap had a phenomenal rally in just a matter of
Yep,
a few days. And all of a sudden, the rules actually made you make a good decision, even though it did not feel good at the time. So there's a
correct.
reason for rules, because you understand markets are dynamic. They are not static, and you need to adapt to what's actually happening in the current marketplace rather than
And yep,
history.
those emotions, mostly fear and greed, those are the two big ones. Those are the top of the list. Those are the ones that make people make the worst decisions. And those are the ones that are in the forefront of your mind the most. It's you're admonished constantly in the world of investing. Don't be fooled by what's going on in the market, and never forget you're the easiest person to fool, because you're going to do it to yourself. So you have to have that rules based strategy that's going to get you and your emotions out of the way, follow the money, follow the returns, and let that lead you to the stronger sectors of the market and away from the weakness in the market. And that's the best way we found to stay out of trouble. And it's far from perfect, but more often than not, you have the best chance of being on the right side of a trade.
Well, what's important is part of that is not getting caught up in the headlines. The
Sure,
headline
yeah,
articles actually give you a tendency to forecast the future, and you do not know the future. None of us know the future, and it does not
right,
matter how much money the money manager on TV has under his responsibility. It could be
right.
billions of dollars. He does not know the future. He just
Nope,
simply has enough money to make a whole lot of bets, and he's going to trim the bad ones as fast as he can.
right.
And that's not the typical investor's realm. I mean, we don't have enough money to be able to make the kind of bets that big hedge funds do.
Correct.
One, they
And
make
then
risky
get
bets.
on TV and announce it to everyone. So everybody knows what they're doing. And it's like,
That's
okay, well, they must know what they're doing. No, they don't.
that's rare, right?
Yeah,
so what is the default action for most investors? It's buy the index fund and close their eyes until the market really tanks, and then they panic and they sell, and they no longer are long-term investors.
that's it.
The models, however, are long-term models. What the financial industry serves up to retail investors is called modern portfolio theory, a theory that was developed in the early 50s by Harry Markowitz as a PhD student who later qualified. He's now a doctor, PhD, and had a Nobel Prize for his idea. But his idea was used as a selling point within the industry. And Dr. Markowitz himself has on public record saying, I would never, never do that with my own money. the financial services industry does not use it the way the way it was intended to use. And basically, it reminds me of Doris Day in a 1950s movie, Please Don't Eat the Daisies, when her theme song was K Sarah, Sarah, it
There you
will
go.
be, it will be. And that's
Yep.
the way most
That,
investors work. I don't know what's going on. It will be what it will be. Just pray, dear Lord, make it work out okay. And
right. That's
actually,
it.
there's a lot of data in a dynamic market that you can focus on the areas of the market that are doing well because the economy cycles and those areas that are active in the economy at the present time generally are doing better than the rest of the market. And rules and data and process can lead you to the front of the line. You just have to commit yourself that you're going to spend some time to do that.
That's
Otherwise,
it.
you've got to find an advisor who'll do that for you, and of which we are one. And if you'd like to talk to us, use the information on the screen here at the end to contact us. It's free. We'll be glad to speak with you and even do an analysis of your current holdings. Thanks for being with us and subscribe. We have more coming.